guys, Freaky Finance here. See, I've been evicted from downstairs. I'm actually in the spare bedroom for this week because Halloween time is fast approaching, so I had to move the computer to the only room that is not Halloweened up in this house, which is the spare bedroom. So, again, this week we're going to do something a little bit fun. It's more just earning season stuff. So I kind of just go through really quickly just what I think about things on the fly as we go. So, no editing, just kind of off the cuff, what have you. So, two today, because I reported this morning, are PayPal and Crocs. We've owned Crocs. We actually just picked it up again this morning, and we're hoping to get it cheaper. We'll go into it really quick. And we'll dive into some of the calls later on as well. If they're more important, I'll do deep dives on them as I get more confident in the names. But we've done a video on Crocs. We've done a video on PayPal. So we're going to do those today. This week, I'm also excited about Google tonight and Visa. For me, and then what else? Meta, still interested to follow. Same with Roku. Don't own them anymore, but still interested in following them. Uber, still own. Amazon, I'd be excited for if it pulls back a bit, but we'll see if it does or not. And then Air Canada, probably be the ones on this list that I'm more interested in during the week. So we'll see how it goes. A lot of companies reported also interested in Robinhood, but it's kind of gone away. And honestly, Global Payments is also another one that's kind of looking a little bit weak, which could be interesting for a buy because it is another pretty strong business, has a decent business model. It's just another payment processor. But anyway, let's jump into Crocs. So like I said, I did pick this one up, and that's right here. Basically in it at 113 even. So not very much yet, just kind of like a position. We rode this once up from about 100 to 140, 150. So we can try to do that again. It's a pretty good business, like the Crocs business. We'll talk about them really quick, but we'll focus on PayPal. I just want to show that I own them both for disclosure purposes, just so you guys know that I own them. So yeah, I own PayPal as well on the Canadian side, on the CDR side, mainly because I wanted to buy American companies last year, but I didn't want to buy US dollars with my Canadian dollars. So mainly because the US dollar was already ripping relative to the Canadian dollar. So I own it on the Canadian side, and it's starting to perform over time, like we thought. It was just getting killed really dirt cheap for a while. So anyway, PayPal, the reason why, if we go back in time, it was because the transaction margin was just so bad because the on-branded, so this is like your Braintree, if you guys remember this video, was basically outgrowing the branded, and it was basically cannibalizing the transaction margin. So transaction margin dollars, while PayPal was still growing, the network was still growing, its margin dollars were actually decreasing. And what the old CEO did was basically cut costs to offset it. And so we're still seeing EPS growth, but it was cost-cutting EPS growth instead of actual like GMD dollar-generated growth, if that makes sense. Anyway, the new guy, Alex, he's pretty smart. He did a couple initiatives we'll go into really quick. And so far, they look like they're at least bottoming the transaction margin dollar decline, which is exciting. I think that's why the stock has reacted so well since we've got into it. So anyway, let's dive in a bit. You can see operating margin finally up year over year. So this is what I want to look at. More importantly for us will be transaction margin dollars finally growing again. And that's something, it was stagnant and actually declining for a bit year over year. So this is important because if that were to continue getting worse over time, then you could say that PayPal is just going to be commoditized away. Or at least you could make that bear case argument. Whereas as long as this is growing and it's scaling on the network, and we know the SGA scales over time, like that's why PayPal has been growing earnings year over year for so long, is because of the top line growth and the natural the scale on the fixed cost side. It's the transaction margin dollar side that we're worried about, or I'm worried about, right? So anyway, so that's improving year over year, which is critical. Excuse me. Another thing, gotta love the buyback. So PayPal was dirt cheap for about the last year, really, even longer. And you can see they've been buying back a lot of themselves, and that's nice when you can buy back. Like I have a $6 billion buyback this year. I mean, they had $5 billion the year before, and the company was trading at something like $60 billion or $70 billion, right? So that's nice when you can buy back a decent amount of yourself, and you can see that they've certainly done that, which I love. We've also seen costs come in a bit because of less stock-based comp, which is interesting because Alex brought in a whole new team. So I kind of want to see if this starts going up as the stock performance starts improving. Well, right now, obviously that looks good. Another source of scale. But the main thing, like we already talked about, is a transaction expense. Now there is a couple noisy things here. So last year they actually took up provisions because a lot of banks and credit card companies were expecting things to be weaker than they currently are so far in lending, and we're seeing that decline year over year, which is actually helping them from a rate of change perspective. So that's also kind of obscuring the transaction margin dollar improvement. So something to keep in the back of your head, that it's starting to look good, but we're not out of the woodwork yet. It's not like all clear signal. It's just not getting worse signal, which is nice, with some improvement. Balance sheet again is immaculate. Another thing here is finally PayPal is growing active accounts again. It went through a phase where it was basically actually declining year over year in terms of total users on the platform. And what it was doing is calling all these fake accounts. And analysts didn't like that because they saw all the headlines for a declining network. But we see that slowly starting to scale again. I mean, 1% is not amazing, but at least it's not declining. And then the main thing what PayPal was trying to do is basically get more transactions per user, and that's been the trend over time. You see this 56 transactions per active account a month, 58, now you're at 60, now you're at 61. But basically they're trying to get people that currently use PayPal to use it more. And that's what's been happening over time. Now one of the cool things is that finally the transaction margin here looks like it finally bottomed, right around 45. Now we're going to see if that's true or not, because 46.6 is nice. I mean, this thing used to be over 50 not too long ago. So that's something to keep in your back of your head. If this thing can keep growing, it can. One of the reasons why it's starting to stabilize, I think, is some of the things that Alex has done. But again, this is just me flagging the main thing that I look at when I'm looking at PayPal. Like when the earnings days this morning, first thing I looked at was the transaction margin dollars going up or not, right? Because I knew revenue growth would be okay. It's just I'm worried about the transaction margin growth for the long-term capabilities of the business. And you can see that it was kind of stuck in this little purgatory. It always goes up in Q4 for Christmas. But you can see it's kind of like flat, and then it starts finally going up year over year. So we'll see if it bottomed or not at 45%. You can see the year over year decreases were pretty stark. Like this one was the big one in Q3 23. It went from 50% to 45%, down 500 bips year over year. And that was like the big, like, oh my god, like what's happening with PayPal? And part of the reason why the margin was getting hit so fast is because the unbranded, the Braintree Pro, was just outgrowing like the branded checkout like crazy, right? So 6% growth from the prior year, so think 2023 versus 2022, and now we're in 2024 versus 2023. So you still have the same branded checkout growth, which is the higher margin business, the PayPal checkout button. That's how the PayPal makes most of its money. But you have the unbranded, which was just growing like gangbusters, and that had lower margins. So the more the revenue growth was driven by unbranded, the more we saw the transaction margin percent go down. But importantly, we actually saw the transaction margin dollar go down, which is scary. So that finally stopped, thank God. Venmo is also lower margin, but obviously the growth is very high, and they also have a lot of extra things that they can start doing with that product, which is more exciting from a merchant point of view. What else is there? So anyway, I just kind of like to point that out. Like one of the reasons why the margin I think is stabilized is one, they started to do more products, like the fast lane stuff. This stuff, yeah. This was 2024 when he first came on. He's like, oh, I got the big thing gonna shock the world. And he did fast lane, basically makes checkout quicker for everybody, which is good for conversion rates, good for merchants. Some merchants want PayPal on their network. They can convert the sales. Smart receipts were kind of interesting. I mean, advanced offers was kind of like giving merchants the ability to see what consumers are buying to try to tailor their offerings better. So we'll see if that is having an impact or not. So far, it would appear that it's starting to, because the transaction margin actually bottomed during the quarter of this announcement, which would tell you that the product's actually improving, the core product, and people are willing to pay more for some of these things. But it's still really early. But so far, so good. I mean, the market's kind of like on a 1 year, you're up 53%, right? And we didn't bottom tick this, I don't think. But we're up, what are we? Up 17% on it. And this thing, if it can go back to 50% margin, starts this trend up, you'll see it start going pretty hard. But just in terms of the business, you've seen it just grow from $8 billion a year 10 years ago to $30 billion in revenue. So It's not like PayPal's dying, like the media likes to say. It's still growing pretty strong. The main thing now is the transaction margin dollar is going to keep it growing well, and you can see the share counts finally just decreasing relatively steadily now that the cash flow is still there. So that's PayPal. Crocs one we picked up this morning. We've owned it twice now. Last time I think it was in February. So it would be nice to get in this 100 again, or 105. I mean, we're at 113, which isn't a bad price. Crocs, totally different, obviously, than PayPal. We're jumping industries here, but that's what we like to do on this channel. So, Crocs is super interesting. The main thing I didn't like about Crocs this quarter is HeyDude. So HeyDude's been a problem since they bought it. They bought it for something like $2.5 billion, something like that. A big amount for Crocs to outlay, and ever since they bought it, it's been nothing but crap. And they keep adding sales support to it. They keep trying to invest in the brands that HeyDude has, but it's not going well. It's like the worst capital outlay decision I think I've seen for a while. So they could have done a lot of things. They could have just bought back, paid down debt. They could have buying back shares. Now, to be fair, they still are with their cash flow, just that they would have been a lot more ahead than they were now. In terms of things I like, obviously the buybacks, like you're going from 62 million to 59 million shares outstanding, and that's still continuing because the thing is, like the cash flow machine, Crocs are very high margin products. The thing I don't like is this SGA line shooting up 60 million year over year, or 56 million year over year. And I'm just like, why, right? And we have seen interest rates come in, partially because debt's lower, partially because rates are coming down. So that's helping them a bit. And then obviously the EPS, the financial engineering of buying back shares, is getting improved with them buying back shares. So the main outlier, the thing I didn't like on the quarter is the SGA. Like, why is this increasing so much year over year? Balance sheet, again, you have long-term borrowing. It's down 200 million year over year, 219 million. So it is coming down, which is nice to see, especially in 9 months. But it's just the whole reason it exists because they decided to buy HeyDude, right? So it's like, yeah, you can, anyway. This is HeyDude just to show, like, it's not just like if you see a headline saying like HeyDude's bad for Crocs, it's because it is. It's not just headlines this time on like the PayPal stuff. It's real. You could see something going down 22% year over year. It's like, whoa, right? Crocs still going up 5 on the DTC side, which is the higher margin side, and HeyDude was always lower margin than Crocs were. So just putting that out there. Here's just another way to show the same thing on the revenue side. You can just see that the sales growth for HeyDude is just crap, and the sales growth for Crocs is okay. However, it's been slowing. So that's also a reason why we make it a better price for something that's probably one of the best products for footwear in terms of margin. And I think they had a step change. Like when we go to here, this was kind of the COVID work from home comfort stuff, and Crocs just took right off. And you see that like they've been basically hovering with profitability. I mean, they've been slowly buying back shares, and then all of a sudden they go from no profitability to $2 in earnings power to $4 in earnings power to $11 in earnings power, right? And I think they got this work from home comfort thing, so they have good product, cheaper, and I think that just it opened them up to more people a lot quicker, and a lot of people were like, well, you know what, this is actually a pretty good product for what you're paying for, and it's dirt cheap to make, right? So they could still make all that money. Like you could charge it. Like when other shoes cost $100, they cost like $30 or $40, $50, right? So anyway, I just like the business model Crocs. Now, one of the things I like to see, we had revenue growth still overall, because Crocs outgrew the HeyDude decline in terms of absolute levels. So when we see revenue still growing, albeit slowing, but we have inventory levels down more than the revenue slowdown. That's what I like to see in terms of absolute levels. So you have 6% less inventory, but you're still selling more year over year. That means we're getting more efficient, which means we should start seeing less markdowns, preferably in the HeyDude brand. That's probably where we're seeing it. Now, they don't break. What I didn't like about the quarters, and what they haven't done is they don't break the EBITDA per segment. Like, I want to know how much of that $60 million in SGA increase was literally due to them trying to invest in HeyDude versus their core brand Crocs. Because in my mind, they should just get rid of HeyDude, right? So I would like to see that, because it would help me measure how good the core business is and how much of this higher SGA cost is to support Crocs versus to support HeyDude. And they don't break that out for me, and that frustrates the hell out of me. If you had if you had to just look at 3 paragraphs from the call today for Crocs, it would just be that. So Crocs brand was adjusted margin 62%, so up 4.6% year over year. That's crazy margin for footwear. Just FYI on the COGS side. And they mentioned that they have lower freight, lower promotions, right? So that would invite lower sales and marketing support, right? But we just saw sales and marketing go up. Now, on HeyDude, you have the opposite. You have something going down 6% year over year. And they claim it's from 5% of basically pushing the inventory out, discounting through digital channels. So we are seeing promotional activity here, and that's where the inventory overhang probably is, obviously. It's here. That's why we're seeing the discounts. Now, are they ahead of that yet? I don't know. I mean, the sales declines are pretty high at HeyDude, so it's not like they have a good product here. And I mean, you're probably going to start seeing more impairments, right, at HeyDude. Like, they won't be non-GAAP, it'll be like that. They have that intangible $1.7 billion, I think it is, on the balance sheet. And sometimes stocks get excited when they write this down, right? And I mean, I'd be writing it down if your sales are constantly declining by 20% after you buy this thing, right? So I think they got to impair this. Maybe I get a super easy entry on the accounting noise of the non-cash impairment, and then I just get a nice little entry into something that I think is favorable long term, especially if they're like, you know what, HeyDude, it's only 20% of our sales now anyway. Let's just let it die or something. I don't know, but it's not a good use of capital relative to the core brand. So weak capital outlay decision. And then when they talk about SGA, they say it's up 2% year over year as we invested more in talent and marketing to support both brands, which is fine. I just wish they told me how much for each brand. And then they say they analyze additional investment for HeyDude, and I don't know what the hell that means. So I would have liked some questions on this, because it was the thing that stood out to me on the call. We talked about China and how underpenetrated. So in North America, they're actually decently penetrated. Europe, they're barely penetrated. And then China, they're not penetrated at all. You can see that with 90% growth year over year. So very strong. And here we are. And they try to defend their higher SGA by saying it's really important to invest in the future, not try to manage from a profitability standpoint. That's technically true if you're managing a business. You don't care about the quarterly. SGA is up $56 million. Freaky gets all freaked out about it. And you're not supposed to, but it would be nice if they told me what they spent it on, so I can see if it's going to continue. Is this just like a step? Usually SGA is like a step function. So you have a bunch of sales growth, and you need to do an SGA increase after the fact to support it, or to support the next leg of growth. And I just want to know how that broke out, and they didn't give any information there. So that's something I'm going to look at on the next one, the annual report for after Q4. And just kind of get a feel for, maybe they bring out the segment EBITDA for me, because the quarterly report was not enough information on that. But anyway, that's Crocs. It's like I said, it's whenever something falls 20% like that, and the numbers weren't that bad. Like, I mean, they still almost guiding to $13 earnings power, right, for a company that has a very interesting brand position and high margin relative to all other shoe companies. It's just interesting. And we knew shoes were going to be weaker, right? We saw the Nike, so I know like the whole industry is relatively weaker. So it helps me know that I'm not buying something that's crazy over earning anymore. We're seeing that pull back. We should see the growth continue to slow, and I get a nice multiple. Maybe I get an earnings reaction on like an impairment that happens on HeyDude side. Maybe they smarten up and they start helping me understand how much they're investing in HeyDude, so I could try to analyze the core business better. But anyway, I'd like to know your thoughts on Crocs or PayPal. I own both right now. Obviously, PayPal is more longer term. Crocs I might trade and then hopefully get it cheaper. but we'll see. Sometimes a lot of companies like to snap up some of these things, especially these businesses that grow like these ones obviously can, as you can see on the board. So anyway, like to know your thoughts, and I will stop talking. See you guys tomorrow. I got to see how Google does tonight. Bye bye.